to plan, steer, and correct an organization's performance. Managers need the right information at the right time, and that is exactly what management accounting is designed to give them. Financial accounting focuses on reports for outsiders like shareholders and regulators, but management accounting information is created for one main purpose: to help managers plan, control, and make decisions inside the organization. Think of management accounting as the dashboard in a car. It gives the driver, the manager, the numbers and signals they need so they can decide where to go, how fast to travel, and when to change course. The first big role of that dashboard is planning, which in management accounting means getting managers to think ahead in a structured way for both the short term and the long term. Planning is more than vague hopes. It is about setting clear objectives, choosing strategies, defining measurable targets, and preparing detailed action plans that say who will do what and when. At the top of the planning hierarchy sit the vision and mission. The vision is a short statement of what the organization wants to become in the future, and the mission describes its basic purpose and often mentions strategy, behavior standards, and values. You can think of the vision as the destination on a map, and the mission as why the journey matters and how people are expected to behave along the way. Below that, we have objectives, also called goals or aims, which spell out what the organization is trying to achieve, and strategies, which are the courses of action selected through the planning process to reach those objectives. Objectives are the what, such as increasing market share, while strategies are the how, such as entering new regions or changing prices, and management accounting provides the data to check if those choices are realistic. Profit-making organizations typically aim first to maximize shareholder wealth, which usually means maximizing profits, and they often add growth, like higher output and sales, as a common secondary objective. However, if managers chase short-term profit without thinking ahead, they can actually damage long-term survival, for example, by cutting important investment or ignoring customer needs, and management accounting helps highlight that risk over time. Non-profit organizations are different. Their main objective is usually to provide goods and services, and a common secondary objective is to minimize the costs of delivering those goods and services. For these organizations, management accounting still matters because it supplies cost information and performance data that helps them stretch limited resources and serve more people within tight budgets. When we talk about long-term strategic planning, also called corporate planning, we mean a process that looks several years ahead and pulls the big picture into one corporate plan. This long-term planning involves assessing the organization and its environment, setting corporate objectives, designing strategies to meet them, and combining all of this into a plan that often covers 2, 5, 7, or 10 years. Short-term tactical planning then takes that long-range corporate plan and converts it into one-year operational plans for specific business units, functions, or departments. These short-term plans rely on tools like one-year budgets, performance standards, and specific objectives, and this is where most of the detailed management accounting work sits, preparing and analyzing those numbers. The other key role of management accounting is control, which starts by comparing what was planned, the targets and expectations, with what actually happened in the results. When those comparisons reveal significant deviations, managers use that information to take corrective action, such as adjusting operations, reallocating resources, or revising assumptions. Control is not just about fixing this year's numbers, it also feeds back into planning because the organization then reviews and adjusts its corporate plan using what it has learned from actual performance. In that review, managers also consider changes in underlying conditions, such as the arrival of new competitors or new instructions from government, and they may update objectives and strategies to keep the plan realistic. Let us pull this together in a worked example. Imagine a profit-making company that starts by setting out a clear vision of what it wants to become and a mission statement that explains its basic purpose and guiding values. From that vision and mission, management define objectives such as maximizing profits and increasing market share, and then choose strategies they believe will help them reach those objectives. Using long-term strategic planning, they assess the organization and its external environment, decide on corporate objectives for the next 5 years, design strategies to hit those objectives, and pull everything into a single 5-year corporate plan. Next, they break that 5-year plan into a series of 1-year short-term plans for each department, such as production, resources, product development, and research and development. Each 1-year plan is backed up by detailed budgets and performance standards, and management accounting staff prepare these budgets and later produce reports comparing actual figures against the planned ones. As operations run, regular management accounting reports highlight where actual performance differs significantly from the 1-year plans, and managers use those signals to take corrective action to get back on track. At the same time, the organization looks again at its 5-year corporate plan in the light of actual performance and external changes like new competitors or government directives, and it adjusts objectives and strategies to stay aligned with long-term success. So management accounting supports planning and control by tying together vision, mission, objectives, long-term corporate plans, and short-term budgets into one loop of measuring, comparing, and correcting. As you study, keep asking how each management accounting tool helps managers plan better, control performance, and make decisions. And if this video helped, subscribe for more management accounting lessons built for CPA candidates.